Straight to our big story tonight. The RBI today announced the much-awaited draft guidelines for new private banks, and according to the new norms, any corporate entity with a 10-year track record will be eligible for a license, provided the inflows from real estate and broking business does not exceed 10% of the group's total income.
Companies will also need a minimum capital of 500 crore rupees to open these new banks. Effectively means corporate houses like Tata's, Birla's, Ambani's become eligible to apply. That's our big story tonight. Our entire banking bureau and of course our entire set of guests. We've got in the studio Viren Mehta, director at ENY, KKR's India head Sanjay Nair, and our banking editor George Cherin. George, first to you. The various prerequisites that RBI has put out, and if you really read into the fine print, what do you get?
Well, essentially, while it does on the face of it give a number of corporates easy, so to speak, entry into the banking system, essentially the fact that they just got to have had a 10-year track record. They've got to have revenues from real estate and equities broking at less than 10% of overall group revenues or even group assets, and the fact that just 500 crores is the minimum capital required for corporates to get into this business. It does on the face of it seem like easy entry, but you need to remember that the threshold level at which they start is a lot more demanding. You've got the capital adequacy ratio for new entrants being set at 12% for the first 3 years. The requirement that 25% of your branch network be in rural areas, and rural areas being defined as centers with a population of 10,000 and fewer people. All of that together really does put them at a slight disadvantage over incumbents. And another very important clause that the RBI has put in is that a recipient of a bank license will not be able to set up a new financial services business, or will not be allowed to get into, say, insurance or asset management at least for a period of 3 years. So this, while it does give them access into the banking space, puts them at a huge disadvantage vis-a-vis many of the other incumbent players. So on the face of it, it does seem easy entry. Once you get in, it's not going to be so easy. At least that's what the final draft guidelines seem to suggest.
Alright, George Cherin, thanks for that quick update. Let's take it then to our special guests this evening. Like we told you, we've got Viren Mehta, director of ENY, at our studio. We've also got Sanjay Nair, head of KKR, joining us live from Mumbai, and we've also got Mr. Ajay Srinivasan from the Birla Group joining us live on the phone line. Mr. Srinivasan, I want to start off with you. What do you make of these guidelines? In a sense, many believe that the RBI has kept its cards close to its chest. There's still going to be a lot of ambiguity on how exactly is it going to be giving out these licenses. What is your sense?
Well, I think the guidelines are a good step forward. I think they build on the earlier comments set on the earlier guidelines, as well as obviously the RBI's vast experience with the opening up of the banking sector in the past. So all in all, I think it's a forward step. I think there will be issues that will get clarified as the guidelines get discussed. But overall, I would say it's a good step, and clearly financial inclusion is a clear focus of the guidelines as well.
There was some concern on whether conglomerates will be allowed to apply for a license or not. You must be relieved that that hasn't come in the way, at least as of now. Prima facie, do you think the Birla Group qualifies to apply for a license, looking at the conditions?
I think that looking at the guidelines as they are today, clearly it looks like we will qualify. We're a large non-bank financial services business, and banking clearly has a good strategic fit with what we're building. So it is a business that we'll be interested in, subject to approvals and the final guidelines.
Okay, let me bring in, of course, my guests here. Hang in with us. Ajay will be back with you in a moment. Sanjay Nair and also Viren, who's with us in the studio. Viren, let's ask you, do you read prima facie what is looking like a fine print on the negative side? There's a little bit of a euphoria, one understands, but what is it that you picked up?
Overall, directionally speaking, it's a step in the right direction. There's adequate clarity about acceptability of corporates to play in the banking world, and also there is a stringent framework being proposed, which will list out the eligibility criteria for corporates who want to enter the banking world. So in that direction, it's quite positive. To answer your question, Shaili, on the negative side, some of these aspects that need little more clarity, some of them need more discussion, especially the ones on listing of the bank in the first couple of years, etc.
Okay, more discussion. Let's bring in also Sanjay Nair. What do you think this could do to the banking sector? Is it really a turning point, Sanjay Nair, or do you think that some of the conditions are really harsh and, you know, when one looks at the fine print, they may not be executed well enough?
My sense is that I think as per the Finance Minister's speech, there's a clear attempt to make sure that a new business model emerges. I think it's distinctly a new business model which will really drive financial inclusion. I think that's the clear headline, and everything, if you ask me, follows from that. The kind of Chinese walls they are insisting on, the kind of capital, the kind of shareholding, and I'm sure we'll talk about it, but I think the overriding thing is, it's got to be a new business model that really caters to kind of a new clientele and new geographic areas.
Right, Ajay Srinivasan, since you're still with us, one of the grey areas really is this talk of diversified ownership, because, there seems to be some amount of ambiguity. What do you mean by ownership and management should be separate? Promoter ownership, in a sense, should be diversified. Is that going to be easy to understand and execute?
Yeah, I think that's one of the areas where more clarity will be helpful, and I think that is clearly something that will come around as the RBI give its further comments on this guideline.
Right, Viren, I want to ask you on the other concern that the street is worried about is the fact that for groups that have more than 10% income coming from realty or from broking services, they're not going to be allowed to apply for a license. Do you think that is in a sense harsh?
It is in some sense harsh, but I can understand where the regulator is coming from. If there are sensitive sectors which impinge upon the risk already inherent in those businesses and add to that the banking risks, then a regulator is rightfully concerned about that. The only thing on the broking side is I can understand the issues relating to prop trading, etc. But if it's a pure play agency business, to exclude the agency players out of that completely, I think that needs a little more discussion.
Okay, Sanjay Nair, the real estate brokerage investments by corporations cannot together exceed 10%. With these norms, are the safety nets in place according to the